To jest podcast System Trader, odcinek 56. A dziś zapraszam do wywiadu z moim gościem, którym jest Wes Gray. Będziemy rozmawiać o tym, dlaczego w inwestowaniu nie warto starać się za bardzo, ale za to warto być cierpliwym, przyjąć długi horyzont inwestycyjny i zaufać procesowi decyzyjnemu. Zapraszam serdecznie.
Interesujesz się inwestowaniem na rynkach kapitałowych? Szukasz swojego sposobu na oszczędzanie i pomnażanie pieniędzy? Zastanawiasz się, jak postawić swoje pierwsze kroki na giełdzie? Ponadto fakty, mity, wywiady i ciekawostki ze świata finansów. To i wiele więcej usłyszysz w podcaście System Trader. Zaprasza Jacek Lempart.
Rozmawiałem już z wieloma ekspertami ze świata inwestowania, ale nieczęsto zdarza się, aby gość był kapitanem w Korpusie Piechoty Morskiej Stanów Zjednoczonych. Po wielu miesiącach przymiarek do tego wywiadu w końcu udało mi się go zrealizować. Moim interlokutorem jest Wes Gray. Po kilkuletniej służbie w Marines, Wes wrócił na najsłynniejszy uniwersytet ekonomiczny na świecie, Uniwersytet Chicagowski, by tam pod okiem noblisty Eugene Fama zdobyć doktorat z finansów. Następnie pracował jako profesor finansów, by ostatecznie założyć własną firmę inwestycyjną, Alpha Architect. W ramach jej działalności m.in. dostarczają na rynek amerykański ETF-y wykorzystujące filozofię inwestowania w wartość, jak i momentum. W tym odcinku rozmawiamy m.in. o tym, czy rynki można pobić, czy żyjemy w wyjątkowych czasach i czy rynki już nigdy nie będą takie same jak kiedyś, czy inwestowanie w wartość przestało działać i tak dalej. Dowiesz się też, jak minimalizować wpływ błędów behawioralnych na nasze inwestycje i jak doświadczenia żołnierza Marines z pola walki przydają się do walki na rynku. Dla mnie ten odcinek to taka okazja też do odczarowania kilku mitów krążących w branży inwestycyjnej. Rozmowa jest przeprowadzona w języku angielskim, ale na stronie systemtrader.pl/056, tak jak numer tego odcinka, znajduje się jej zapis w języku polskim. Serdecznie zapraszam na stronę również, ponieważ umieściłem tam szereg materiałów uzupełniających. A teraz już serdecznie zapraszam do wywiadu z Wesem.
Hello, Wes. Thank you so much for accepting my invitation to my podcast. You are very well known in the industry, but just for the, let's say, pure formality, could you please introduce yourself?
Sure. So I'm the CEO of Alpha Architect, which is an asset management firm based in the U.S. here, where we currently have just under around $1 billion in assets under management. About half of that is separately managed accounts for high net worth individuals, and the other half is ETFs or exchange traded funds.
All right. I know that you were serving as a captain in the United States Marine Corps. So how it happened that after serving in the United States Marine Corps, you decided to move to the financial area?
So I actually had started in deep finance beforehand. So right out of college, I basically went to grad school and was in the PhD program for a few years. And then I actually left, went on a sabbatical, was in the service, the Marine Corps in particular, and then did that for 4 years. And then I re-entered the PhD program to finish off my dissertation and research, and then became a professor and then eventually launched the business. So I had like a weird path where I was in finance before, went to the service for a while, and then came back.
All right. We'll talk a bit more about what Alpha Architect does, but just before we will go into that, it happens that actually the ETFs you are providing are only available in United States. And like, for example, I'm in Europe. What is the problem that the ETFs which are offered in America, they cannot be accessible in Europe? Is it so hard to meet some legal requirements, or there are some other issues?
So we looked into this fairly extensively a while ago because we have so many people that read our, blogs and books and what have you. And the issue is that the requirements that actually the European financial requirements are actually conflicting with SEC requirements. Mm-hmm. So the only way that you can really facilitate that sort of operation is you literally have to set up a separate business entity in Europe. Most people do it in Ireland, which is obviously extremely expensive and outside of our, capability essentially. So really the only people that can do that would be firms like iShares, Vanguard and what have you. But smaller boutiques like ourselves, even though we have almost, like I said, $1 billion under management, that would require investment that is just beyond our scope And so unfortunately, we can't comply, because if we complied directly with our current entity, it would be be conflicting with the SEC regulations, which is our regulatory body. And we don't have the funding to be able to launch an entire different business in Europe with its own entities and own, its own footprint over there, unfortunately.
Sure, I understand. That's a pity. I mean, you would have to open an office in Europe.
Yeah.
Do you think that, by the way, your military background drives certain character traits that are useful also on the, let's say, investing ground?
I do. One of the things that you learn in the service is basically how to make decisions under duress and where there's a lot of chaos and emotion involved, which is in many respects like financial markets. Like obviously in financial markets, you're not getting shot at and, people trying to blow you up, but it's the same sort of idea where you as an investor, you're trying to make a decision amidst a lot of uncertainty and a lot of stress and chaos in financial markets. So I think a lot of the things you learn in the military, in life in general, are very applicable to financial markets for sure.
Right, because by the way, I've noticed that Alpha Architect as a company is a veteran-owned organization because you have people from U.S. Navy, U.S. Marine Corps, U.S. Army. Is it just a coincidence, or there is some rule in it?
No, I think it's just the characteristics that I value, like people that are, all about doing service and, paying their respects to the country and not just being only about money is something that I was just find like a good character trait. And then also just because I know how they're trained and I know they have a inbred capability to deal with making good decisions under duress. It just tends to be the case that people that are in the military, it doesn't have to be in the military. Obviously, we have people that aren't in the service. They have those characteristics that are favorable for our business and what we're trying to achieve.
You earned an MBA and your PhD in finance from the Uniwersytet of Chicago, where efficient market hypothesis was created.
Yeah.
And you mentioned on your blog how you wrote once an email to one of your dissertation advisors, Professor Eugene Fama, who won the Nobel Prize in economics. And basically, you wrote there about your finding about the Value Investor Club, where you stated proudly that this paper shows value investors outperform the market. And the first sentence of his response, Professor Fama, was that your conclusion must be false. So my question is, if you could just tell us a bit more about that situation, and what do you think personally about the efficient market hypothesis? Is the market efficient?
Yes. So I'll hit your first question, then your second one. So on the first one, obviously when I got that email, after I'd spent a year working on that paper, I was like, oh God, I'm never getting out of this place. But really what he was, unhappy with was the wording, because my statement, he's very keen on language and being very precise, which is obviously reasonable. And I had said that, all basically implied that all value investors can beat the market. And then he made me change the language to say that the sample of value investors I analyze seems like they can beat the market, right? So he's a stickler on precise language, which is obviously a good thing. So that was kind of the situation there. In the end, it wasn't a total like, this is stupid. It was more like, you need to just fix your language a little bit, thankfully. And then as far as my thoughts on the efficient market hypothesis, I'm actually a huge fan. So, and I'll tell you why. I think the efficient market hypothesis is a great null hypothesis in the sense that it sets people up for success, not failure. I think it's much safer that when people approach the markets, they just assume that prices are correct. You can't beat it. There's not free money lying around. It's incredibly difficult, et cetera, because then in order to convince yourself to do something more active or something that you think can beat the market, it requires a lot more effort. As opposed to the inverse of that, where we just assume markets are wildly inefficient and there's free money everywhere. A lot of times that'll have people go down paths where it seems like it's easy, but then they didn't realize that, wait a second, the market was efficient and, maybe I was picking up pennies in front of a steamroller and now I lost all my money type of thing. So I'm a huge fan of it as a baseline null hypothesis that we can build upon with a lot of rigor and thinking deeply about, well, why does this not apply in my unique case?
Right. So as Buffett says, investing is simple but not easy.
Mm-hmm.
On your blog, you wrote a great article titled "Even God Would Get Fired as an Active Investor."
Yeah.
Could you please tell us what the main conclusion from that article is for active investors?
Sure. So one of the main conclusions from that article is that even if you are an exceptional active investor, you're going to go through long periods of pain and anguish trying to convince your clients that you're really smart. And the way we kind of brought that to bear is we just took a portfolio that cheats, right? Because after the fact, we already know which stocks, were the best winners over 5 years, for example. So we just did a portfolio sort where we just created portfolios that on purpose buy the 10% best winning stocks over the next 5 years. And that portfolio obviously does extraordinarily well. But what was incredibly surprising to us is that portfolio also is subject to a lot of generic market risk and volatility and bouncing around. And so even someone who is perfect, i.e. you get a cheat and look ahead for 5 years with the best portfolio, you still face this problem of every so often in the short run having to explain to your investors why you're not a total idiot, even though you're obviously the best investor that we could possibly imagine. So it's just a good lesson that if you don't have a long horizon in investing, there's no way you're ever going to probably win, and you're going to end up, buying at the wrong time and selling at the wrong time more often than not.
All right. I'd like to talk also about models versus experts, because you have another great article, another paper, Behavioral Finance and Investing, Are You Trying Too Hard? And I would like to use that to discuss some, behavioral aspects of investing. What is the main difference between systematic investing versus the discretionary investing? And is it possible to say which is better or easier, or maybe let's say more practical, or maybe more recommended?
Well, so the key difference between systematic investing and discretionary is somewhat in the language, where systems try to build rules ahead of time that you'll deploy in practice, where obviously discretionary, the rules can change, everything can adapt depending on conditions. So those are, two methodologies that someone could use, or someone could mix them, right? And the main reason that we favor the systems approach is because systems are nice in the sense that you front load all the research, you front load all the decision making into a set of rules that you can empirically test, try to understand why they work and how they work, and then you deploy them in practice. The reason that's beneficial is because when you're making the decisions on what are the rules up front, you're usually in a state of mind where you can think deeply, you can think rationally, you're not subject to, what's the stock market doing today, and you're less prone to having a behavioral error. Whereas if we don't have rules set up front and we allow ourselves to kind of make decisions on the fly, that's nice because in theory that could be more adaptable to new and changing market environments. But obviously the downside of that approach is now you're also opening up the possibility that the decisions you're making to change and adapt are actually more influenced by, emotions and poor logic, as opposed to being value add changes. And it seems to be the case, at least based from, 70, 80 years of psychology research at this point, that most of the time and in most circumstances, it makes more sense to build systems and stick with them as opposed to relying on, kind of ad hoc decision making. It doesn't work for most people. So that's a long way of saying that we recommend people follow systems, but that's not to say that there aren't some people out there who, like maybe Warren Buffett would be a good example, where, yeah, they're discretionary, but they're also so rational and so good at containing their emotions that maybe they can make that work for them. But that would be the anomaly. That's not the norm, is what I would suggest to people.
So let's say that we have an expert with years of experience in the particular field, let's say in investing. And do you think that such people are better equipped to make unbiased decisions to overcome these behavioral issues? Mm-hmm. Or is such assumption simply not valid?
So it's actually counterintuitive, but most of the folks that actually study this exact question highlight that experts are a lot of times even worse than normal people. And the key reason for that is really confidence, right? So the problem is whenever you're an expert in something, you start to establish an ego in that particular expertise. And that usually leads to becoming overconfident in your own knowledge. Whereas kind of the nice thing about being ignorant, and they say ignorance is bliss, is you go into a lot of problems where you know you don't know anything, so you're less likely to actually think you know something. Whereas the problem with experts, if they don't build systems and ways to avoid the overconfidence problem, they'll a lot of times make decisions and come up with forecasts where they will be 100% confident that this is correct because they've been doing this for 30 years. And the problem is they've eliminated the possibility that maybe they're not correct. So again, there's really a trade-off. Like obviously experts are great because they have a lot of knowledge, but there's also the curse of knowledge. When you think you know something really well, you tend to get way overconfident and then you end up blowing things up. So, and it seems to be the case that on average, experts in many respects actually are worse decision makers even than normal people because of this behavioral drag associated with overconfidence, basically.
Okay. And in your article, you mentioned, and again, I will go back to your career in the U.S. Marine Corps. You mentioned about the standard operating procedures, and basically it's a kind of, let's say, maybe I'm oversimplifying that, but it's like a kind of a algorithm how to adapt or what to do in a certain situation. Can we use similar approach to investing? I mean, that we have experts, we put them just to prepare such standard operating procedures. So we will use their experience there, but not on the real market. It's just offline, let's say. And then we just use their experience, which is already in the form of a kind of a procedure or strategy.
Yeah. So the military and specific, the Marines, they've learned this through years and years of the highest intense, most competitive environment ever, where if you make bad decisions, you can die. Right. So there's a lot of incentive in the military to come up with good decision-making processes, in ways of thinking about the world, because the downsides are huge. Obviously, one would argue that in the financial market, there's also downsides because you can lose a lot of money, but you think that at the margin, the military is got the most to lose. So they really think hard about it. And basically what happens in the military, specific in the Marines, just because that's where I come from, is the whole point of standard operating procedures is up front. We want to rely on experts, people that have been in military situations for years and decades to come up with rules that we want to train people to follow, because we know that when they're in those contexts, because of the emotions and because of the chaos, a lot of times they'll make a decision that is actually not the right one because it just feels good, but it's not actually the right idea. And I'll give you an example. So one example would be like when you're in an ambush. So if you're in an ambush, that would be a situation where you let's say you're on a patrol or something, right? You're walking into an ambush where on both sides of you, all of a sudden the enemy has captured you, right? They've set this trap up for you. Now, the intuition, if you weren't trained and if you didn't rehearse, you didn't practice rules, is like, oh my God, what are we going to do? And it gets complete chaos, and like one person may shoot this way, one person may try to run through the ambush, so on and so forth. Well, it turns out that all of the things that people think they should do in an ambush intuitively are exactly wrong. Because in an ambush, the standard operating procedure is counterintuitively run towards the most intense fire. And even though that doesn't seem to make any sense, the reason that makes sense is because if you can get to the most intense fire, typically once you get through that, the ambush is completely eliminated because the enemy doesn't usually create support plans for people to act like that, right? They expect you to actually go in, like try to go through the ambush zone faster and do all the things you're not supposed to do. So the standard operating procedure says, listen, when you're in an ambush, despite what you feel or what you think you should do, you need to not go run through the ambush because that's what the enemy is expecting you to do. And they're going to like just create more ambushes for you there. You need to actually look at where is the point of impact that is most painful, and ironically run towards that with all your guns blazing as fast as you can. Because time and time again, we've learned that that is the approach that will actually minimize, your casualty rates and maximize your chance of success, even though it feels in that moment like the worst idea possible. And so again, the reason you have those rules up front and the reason you train them and the reason you get people to say like, hey, we have to throw away what we feel, we need to follow these rules, is because these have been established, with years of experience, years of thinking, years of data as the best. Nothing's perfect, but these are the best ways to, achieve some goal. And so again, the analogy to investing is you want to establish a rule up front, because when you're in the ambush of a market, and let's just say the market is in chaos, right? It's, you're down 20%, you're down 30% or whatever it is, all your intuition and all your emotions are saying, for example, sell, get out, like we're all going to die. But the reality is kind of similar to like how the operating procedure in the services, when that chaos happens, you don't do that. You actually go towards the chaos. So maybe the rule is if you're in a massive drawdown, you don't run, you actually like double up, right? You go into the face of chaos because that might end up being a better decision. But the main point is you want to establish rules ahead of time where you're thinking in a sane state of mind. And then once you have those rules in place, you implement those in these emotional, stressful events, to try to eliminate bad decisions that occur when people get stressed out, basically.
Right. Great. Thank you for that. So it seems like we should switch off our system one, let's say, and we should rather follow the procedures.
Yes.
Because the emotions are not the best idea to follow them in such a stressful situation.
Yep.
But what if experts then, let's say, if we go back on the markets, what if the expert would use models? So let's say that we have a model, we have a procedure. Do you think that this could be helpful to improve decision-making process also for experts?
So this is a hypothesis, and it makes a lot of sense at the outset. And the basic hypothesis is, okay, we have some standard operating procedure or model that has these rules that seem to make a lot of sense. However, we also have an expert who may have a lot of, great judgment, decision-making experience, and they're going to be able to pick up particular nuance. So maybe what we can do is we can have an expert use discretionary decision-making alongside a quantitative, model or systematic process. So people, and this is kind of intuitive, you kind of get the best of both worlds, right? You get the expert's judgment and the model's, sanity and good baseline ideas. So the problem with this approach is, or it's not a problem, it's just there's a trade-off, is in theory it could work. You have the system plus the expert that can, adapt to the situation and presumably add value. But going back to our discussion prior about experts and discretionary processes, is the experts are humans. And the experts always, in general, tend to get overconfident in their ability to look at a unique situation and apply their expertise to add value above and beyond what the model was already telling you. And so even though it's a great theory, when people actually study this in the labs and in different contexts, on average, it's better to just follow the model and not listen to what the expert has to say after the fact versus following a model, but allowing an expert to kind of tweak it and twang it, when you're in the midst of chaos. So again, that's what I think the evidence suggests. And it makes sense when you've understood how the human mind works and you understand that experts tend to be overconfident. It's just their potential benefit usually gets outweighed by the cost of the fact that they're still humans and they make errors. And there's not really a way to eliminate that as far as I know.
Okay. But some may say that, for example, the procedures or the strategy, that the enemy will know this. So let's say that he will try to use this against you. And some can say, for example, that some algorithm, some strategy may stop working because the market anomaly will be eliminated because too many will try to follow it. Would you agree with that?
Yes. So intuitively at a high level, that makes sense, right? Like, cause in the end, markets are determined by supply and demand. So no amount of academic research and theory is going to change the fact that if all of a sudden there's something that literally represents free money and a lot of people find out about it, that's going to be eliminated. That makes perfect sense. And we should always be cognizant of, if there's too many smart people doing the same thing and it's really easy to exploit, we should just assume that over time or in short order that opportunity will be eliminated, right? And so that's why it's really important whenever you're in the context of financial markets that when we identify something that quote unquote works, right? It looks like a good idea. It's something that adds value, like, wow, we can beat the market. That we don't want to get too excited because really what we want to explore is, well, why did it work? And was it really that easy? Like why weren't all the smart people doing it? And so really kind of the sweet spot in the market context is if we can identify systems that identify what appear to be really unique ideas that help generate, excess returns or what have you. The next question we want to be able to answer is, well, is it actually kind of hard in the end to take advantage of these different systems? And maybe that's because you take on different risk or, maybe it requires long horizon and you have to do things that feel weird and are different. That could be a pain point as well. We want to make sure we identify those because if we don't identify why something is making a lot of money, but it's not hard to do, we should probably just assume that it's going to disappear very quickly as a general principle of just competition in the marketplace. I don't know if that makes any sense.
So would you agree that because of the behavioral biases, we have certain anomalies like, let's say momentum, for example, and because of that, it's working, but in the long term, but in the short term, there's a pain to go through. So no pain, no gain.
Yeah, exactly. And so for momentum, for example, is a pretty good one. There's a ton of evidence, obviously, that the most simple of strategies you can ever imagine, just buying winners because winners keep winning. It seems like, well, how could something that's so easy like that work? Well, the reason that works is because if you actually look at doing those strategies, a lot of times they expose you to some additional volatility, because they whip around a lot more on the upside, which is great, but also on the downside. But even when we account for that volatility, they still seem to generate excess returns. So you'd ask the question, well, why don't smart people just do that? Well, they generate those excess returns, but when you look at momentum strategies and implementation and you look at how they perform relative to, say, standard benchmarks and, other things that people pay attention to, well, the downside is if you're a pure momentum person, you have to do things that a lot of time feel extremely painful because you could be way above the market, but you can very easily be way, way below the market for extended periods of times. And to the extent that creates pain and anguish for you because maybe your investors, start throwing tomatoes at your face or whatever it is, there's a cost to doing these strategies, which is prevents a lot of smart money maybe from doing them because, yeah, it looks good on paper, but in reality, if I do this strategy, my clients are going to hate me, what have you. It really does go back to, we always want to identify, where is the pain in this thing? Cause I know it's here somewhere. And if I can't identify it, it probably means it's not going to be a feasible strategy for the future, unfortunately.
Right. Most people are very skeptical about, let's say, systematic approach because it's very counterintuitive. And there's an old quote by Peter Lynch who said that you can't see the future through a rearview mirror.
Yeah.
And how would you reply to those saying that, especially now when they say that this time is really different due to, for example, zero interest rate policy? Mm-hmm. Does it mean that all we saw in the past, in the historical data, is not applicable, and based on that, we cannot just simply build a reliable model for the future because we have never seen such thing before?
Yes. So, I mean, in the end, who knows? But I always focus on just human nature and first principles. And one of the things that we do know is that stock markets and news flow, 99% of data represents noise, and it doesn't give us any sort of reliable way to improve our forecast. So if you start off with that baseline assumption, which is empirically been shown over and over again to be the case, what I mean by that is people get so attached to different data points and different narratives, and they implicitly assume that they have forecasting value, which is when they say, hey, we should change or adapt. That's what they're saying indirectly. This signal has forecast value. Well, the problem with that statement is that most signals don't have forecast value. And the reason I make that point is luckily we have literally at this point hundreds of years of data on every single market, every single asset class, everything you can ever imagine, where we've been through world wars, civil wars, Great Depressions, things that are so crazy that they make even our current situation somewhat pedestrian, right? Everyone's wow, we're in a, this pandemic and oh my God, interest rates are, it's guys, we've been in World War II's, situations where people are dying. Millions of people are dying. We don't even know if the future of civilization will exist in the next 5 years. And you're worried about COVID. Yes, I understand that's unique and challenging, but in the context of the history of mankind, this is nothing, right? And so through that historical lens and that broader context of, is this time different? It's always different, but in the end, it boils down to understanding human nature. And what I've kind of came around to after, beating my head against the wall for so long is in the end, what matters is the human. And what humans care about is they like reward and they don't like pain, right? And so in the end, whatever investment strategy you're going to do or whatever you're trying to predict, what I always think about is one thing I know, one first principles of markets and mankind and humans is that humans like rewards and they don't like pains. So whatever algorithm, whatever system, whatever I'm trying to do, to the extent that I'm thinking about marketplace as basically a collection of humans that enjoy gains and don't like pains, whenever I identify systems or I'm going to change a process, I need to make sure that whenever I identify a situation where there looks like there's a potential reward, I need to identify, well, why do the humans maybe not want to do this? Because there's identifiable pains. And they may not be explicit. They may be more complicated because of career risk issues or requires discipline and a long horizon, what have you. But if I can't identify those pains and those gains on whatever decision I'm making, I'm not going to rely on it as something that's going to actually increase my forecast ability. And maybe a good example of that might be ESG investing, right? So, and I have no issues whatsoever with ESG and the principle and the idea of hey, if we can leverage our investments to improve, economic or, environmental health, social health, whatever, that's great. Right. But if I think about it from investing perspective, when people tell me that they expect to earn higher returns by investing in ESG type ideas, like things that are better for the environment or whatever, I say, okay, well, that doesn't make any sense, because I'll tell you why. Why would you expect more benefit something that's actually less painful? Where less pain argument is that, well, if you're investing things that basically give you a hedge against, like companies that have a hedge against a tail risk associated with, environmental destruction or what have you, that's actually a huge benefit, right? Because they're basically providing you insurance against the state of the world that, we're going to burn the forest down or whatever. So if anything, if you're going to buy insurance, you would expect lower expected returns. Not to mention that it's incredibly easy from a career risk standpoint, a sales and marketing standpoint, to be able to hold firms and companies that engage in activity that makes you feel good and happy about what you're doing. So if that, to the extent that that's beneficial to the humans who invest in these things, why would you expect them to earn higher returns, right? Because in the end, I know that humans, if they want to get higher rewards, they require higher pains. So if you ever tell me a story, you have an investment approach or anything where your story is all about why this is less painful for the humans, all I'm thinking in my head is, well, this is going to give you less return than, over the long haul and out of sample. So that basic principle, which extends beyond like what the Fed's doing or whatever, is just something that I always force myself and I encourage other investors to do is if you identify expected benefits, we need to make sure we understand where are the expected costs, because that's how the markets will in the end price them. Is a high level framework for thinking about all these things.
Yeah, it makes sense. Thank you for that. So in the end, we are just humans, so we may be in different times, we may have different problems, but in the end, we have the same emotions. And I think that the evolution doesn't work so quickly that within a few centuries, we are adapted to be so rational on the markets.
Yeah.
You wrote that once you believed to become the next Warren Buffett, and your grandmother, I think you were 12 at the time, gave you a copy of Benjamin Graham book, The Intelligent Investor.
Yeah.
And of course, it's about the value investing philosophy, and you really like that, and you were impressed by that investing style. Do you think that it's possible to really replicate such approach, which then was used by Warren Buffett, using purely quantitative approach?
So the short answer is yes. And kind of one of the interesting things that we actually studied is this exact question. So if you look like Ben Graham, I originally start off Ben Graham, which he essentially, when you actually read his books and you read his writings, promotes a systematic approach where it's like, hey, buy really cheap companies with a margin of safety and hold your nose in the short run, because over the long haul, you'll capture these, risk and behavioral mispricing premiums because humans are crazy. I moved from that to read about Warren Buffett, and most people do that because they're like, wow, Warren Buffett was so successful. And then you get the idea that, well, maybe you can add your stock picking skills to win. And I tried that, like most people try that. And then I eventually got destroyed, which I had to eat a lot of humble pie, which made me kind of do a full circle back to essentially the Ben Graham concepts again. Like, hey, simple rules that capture human nature, stick to them, and hold them for a long haul. That seems like a good idea. And so one of the things that we did as an interesting study is Ben Graham talked about basic idea of, hey, buy cheap stocks with a margin of safety, and you'll earn around 15% a year, and it'll be volatile as heck, but it works. And he does this study where he literally does this approach, basically buying low PE stocks that don't have too much debt and a reasonable quality, systematically. I think it's from like 1920 to 1970 or something, right? And he writes this article about it in some journal right before he passed, in a CFA journal. It was Financial Analyst Journal. And so what we did, with the benefit of hindsight, this was in, about 5-10 years ago, we said, wow, all these people argue that, these value strategies, they're just too easy. They don't work. Well, Ben Graham wrote about this in 1970, like buy cheap and amongst cheap, get high quality ones. Hold your nose. It's going to be painful as hell to do this, but over the long haul, it'll work. And so we just replicated that from 1970 up to 2000 and what I remember 10 or something like that. It just low PE, but high quality, low PE. And let's just look at what happens over the next 40 years out of sample. And guess what? The same thing. It had around 15% return, insane volatility. You look like a total idiot over 5-10 year periods sometimes versus the market, but it worked, right? And so this is completely out of sample, same strategy. It's so easy. A caveman can do it. Same result. And so that was very perplexing to me. But not really after knowing how humans work, right? It's a simple strategy with simple rules that we can show people, listen, this works. And it works because there's a lot of pain involved. So yes, there's a lot of gain. You get these excess returns over the long haul. But we're going to highlight that it's also a lot more volatility and there's huge opportunities to look like a total idiot for extended periods versus some benchmark, right? And to the extent that's painful because you always worry about what your neighbor's doing. You're not worried about your own situation, which is an unfortunate blight with human nature. We always care about what other people are doing. This is very, very painful to do, even though it seems so easy. And the best analogy would be dieting, right? Like if people are overweight, you say, well, to lose weight, it's simple. Eat less and work out more and you will lose weight. And you can give them all the evidence in the world. You could tell them how easy it is. It's the easiest algorithm of all time. And yet when you tell the fat person to do that, for some reason they just can't do it, right? So we know there's a reward, but it's also has a lot of pain. And so just like dieting or anything in life, it's just like investing. At Ben Graham, I think people just have to relearn these kind of lessons over and over again. I can't explain why humans are what they are, but it just is what it is. And I've circled back to the Ben Graham philosophy over time. It just took me 20 years to get back there.
Wow, that's a long journey. In the light of the fact that it's hard to beat the market, what do you think then about passive investing? I mean, where we just, let's say, create a permanent global portfolio.
Yeah.
And the only thing we do is from time to time, we do the rebalancing. Does it make any sense to you?
I think it makes a ton of sense because when you invest, really what you got to focus on is what you can control. And what you can control potentially is your behavior, your taxes, and your fees. So to the extent that you're like, you know what, I've read enough about Dan Kahneman's books and research on humans, and I know myself, I just can't control my behavior. Fine. I can control my fees and my taxes. So passive investing is a great solution for those who have eaten the humble pie and just recognize that they just can't deal with the behavioral problems. But I'm at least going to control my taxes and my fees. So I think it's a very reasonable approach for people that they're just cognizant that they can't manage their own emotions. Passive works great. And the only reason you would want to deviate from that is to the extent that you also are going to focus on what you can control. And one of those levers is your behavior. And you can look yourself in the mirror and say, over a 10-year period, I want to outperform, but I'm also willing to underperform for 8 out of those 10 years. And I'm fine with that. And if you're cool with that and you can control behavior, then okay, maybe now you should deviate from, passive, low cost, tax efficient portfolios. But that's a very challenging thing that you ask of yourself. And so I don't really recommend it unless you have very high confidence, ironically, in your ability to not make stupid decisions. Otherwise, passive is probably a good baseline for a lot of folks out there.
Okay, because passive indeed, it's again simple but not easy.
Yeah.
But as you said, I think that for majority of the people out there, the problem is that if we try actively invest our money and we look different, and especially if we temporarily we lose against the broad market with
Yeah.
the passive investors, then it feels us very, very bad. And therefore
Yes.
that's why it's so difficult. Okay. Your company specializes in providing factor ETFs. Could you just simply explain to those who are maybe not so experienced what is factor investing, why it works or why it doesn't maybe work?
Yeah. So the simple way to think about factor investing is we're just going to look at the characteristics of individual securities and try to understand how those predict expected outcomes. And then we're going to form portfolios on these characteristics that we know on average are related to particular outcomes we may want and build portfolios that way. For example, we know historically, and I'll explain why people think this works. We know historically, for example, that buying smaller, cheap stocks in general, firms that have like cheapness characteristics and small characteristics in combination, on average, earn higher expected returns than, say, large stocks that are really expensive. So we may form a factor portfolio, like a small value portfolio, where we own securities that own this characteristic because we want to capture this long-term excess return goal. But then the question is, well, why? That's pretty easy. Just buy small, cheap stocks and you beat the market. Well, again, there's a reason probably why characteristics predict expected returns. And that reason is that characteristics typically proxy for pain in this context, right? So owning small and owning cheap securities, even though that's just the characteristic of underlying stocks, well, those characteristics usually proxy for additional risk, right? Because when you buy small stuff that's really cheap, well, it's probably because there's some fundamental risk associated with those companies. Why would they be cheap? And if you're small, intuitively, like may have less access to capital or whatever, right? So there's some kind of logic there of, well, that kind of proxies for extra market risk. And to the extent humans don't like pain, or which is usually risk, that you probably get to earn extra return. The other component is, well, what if there's some sort of like pain of doing this strategy because it doesn't keep up with the Joneses or it doesn't track the broad market perfectly? Well, as is the case in a lot of things that are active, these small value portfolios, when you look at their relative performance to like a baseline benchmark, are extraordinarily painful. So if you're going to sign up to do this factor portfolio, you are basically signing a death wish of just living a life of complete misery, because you're going to be obviously happy when you beat the market every so often, but you're going to be extremely unhappy and want to just end this misery, because these portfolios can also underperform over 5-year periods, with a high probability. Actually, it's a non-trivial probability. So in the end, factors again are just, how do I build portfolios that on average seem to generate higher expected returns? And the reason why that is typically the case is because these characteristics of these factor portfolios proxy for pain. And as we talked a little bit ago, like in the end, markets work, right? Like more gains, usually more pains. And so that's all factors are trying to do, is how do we smartly and efficiently, capture pains in anticipation, if our goal is obviously to generate extra returns, get extra gains. You can also use factors to, systematically maybe lower your pains, but that's also probably going to lower your expected gains. But at least it's an efficient way of doing it, as opposed to, throwing a dart against the wall because you think some company is going to do, something or not do something. It's not a very systematic way of going about it.
Okay, so factor investing, again, no pain, no gain.
Yeah.
But for those people who are interested about such approach, your ETFs are fully systematic, right? There is no place for discretionary decisions.
You got it. So on the whole point of our ETFs is we're very cognizant, and a lot of people are in the business, that the biggest challenge of investing is not knowing what works or how it works. It's getting people to think long term, right? And because there's a lot of things that people know that work, and those are things we focus on, right? So buy cheap, value stocks, buy winners. But we also know that if you build those portfolios correctly to exploit those potential benefits, you have to have 10, 20-year horizon, because these portfolios are constructed to fail in a short-term sense. And so our products on purpose optimize on as much pain as possible. And then what we then tell people is like up front is, listen, we're not smarter than all the other PhDs out there. We're just a lot more transparent. And we're going to at least give an offering in the marketplace that will allow people that can truly have 10, 20-year horizon and are willing to stick with the program. We're going to at least offer products that allow you to do that. Because in general, most product offerings in the marketplace are not designed to deliver this kind of excess pain, because the asset managers don't want that pain, because they would rather kind of stay close to the benchmark, because, then you're less likely to have your investors run away. Where we kind of like up front, I talked about the ambush. When you're in an ambush, the intuition is don't kind of placate the ambush. You actually want to run towards the gunfire, right? So that's what our products are doing. They're like, listen, we're going to take on the biggest challenge head on and deliver you the most behavioral pain you could possibly fathom, because we believe that over the long haul, that will give you the gain. And we're going to tell you that up front. And so to the extent that you want to do that, great. That's what we're for. And that's why we're different, but obviously it's not for everybody. So that's all we try to do with our ETFs and our factors, is just at least give people the option to, engage in this kind of masochistic activity, I would say.
Right. So if someone decides to, let's say, invest in such factor ETF, do you think that it's good for such average person? Let's say the person is not an expert in investing. It's good just to buy it, even maybe automate the buying subsequent ETFs, but just close the account. Not look into the account and forget about it. Just focus on your life, on your career, and just let the market do its job. Do you think that such approach is good, just to avoid this positive and negative emotions?
Yes. So to the extent that you can set yourself up for behavioral success, and you don't pay attention to like the TV, the press, and what the Fed's doing, what the government's doing, what the politicians are doing, you are structuring your life as an investor to be a good one. Because now you really have like 10, 20-year horizons where the risk of you opening up a statement and saying, oh my God, this is doing amazing, I should double up. Or, oh my God, this is doing terribly, I need to sell it all and buy the next shiny rock. If you can eliminate that problem, you are now in the perfect position to, own things that capture long-term investment premiums, which would be own market risk, own deep value stocks, own, these winners. And yeah, so you should definitely do that, to the extent that you generally know you're not going to like start reading the newspaper every day and worrying about it.
Right.
Yeah. And of course, if that's what you know you're going to do, then you need to make sure that you're a little bit more careful about how you think about your investing, because now you got to weigh that against your behavioral baggage problems.
Looking on the ETF's performance you have on board, as alpha architect, it's obvious that in the recent years, momentum ETF gives better results than value. Mm-hmm. And of course, there's a lot of comments again that value is dead and stuff like that, which is happening. We had momentum was dead as well in the past. Now value is dead.
Yeah.
As they say.
Yeah, exactly.
Is it, from your point of view, if you know the history from last century, let's say, is it normal and temporary? Or that's what we are talking about? This is just the pain you have to go through. That's why it works.
Yeah. So to your point right now, because momentum things have done so well, everyone thinks value is stupid. Another argument these days is, well, because the U.S. stock market's done so well, international value is stupid, right? But as you know, and as anyone who's ever studied the history of mankind or the world, these things mean revert. And so the reality is nothing works forever. And so what we want to do is we want to pool smart ideas that all on their own 2 feet, have some sort of long-term expected benefit or what have you. But we don't want to ever go all in on any one idea. We want to try to take advantage of diversification. So we always tell people, listen, momentum is obviously doing way better right now, but that doesn't mean you shouldn't also own value. And in fact, you should probably 50-50 the things because, one is sometimes working, one sometimes isn't working. And oh, by the way, and this is for U.S. investors, but it's the case for any investor around the world. Like most U.S. investors have like 90% of their money in U.S. stocks and like maybe 10% in other stuff. We always tell people, listen, the U.S. stock market is not the stock market that always works. Sometimes it's Europe. Sometimes it's Japan or whatever, So you should also spread your bets across the globe. And we usually recommend basically around a 50-50 because that approximates kind of like the global market caps. But the main point is have baseline diversification. Don't be focused on short-term performance and just try to invest in ideas that are evergreen and kind of stand the test of time and pool those ideas in a sensible portfolio where you don't touch it too much. And you got a 20-year horizon. You don't have to worry about it. And then to your, go hang out with your kids, focus on your job, focus on travel, focus on life. Don't worry about markets because if you do, you'll go crazy. Do stupid things. So, that's kind of my high level advice.
So it's good to mix value and momentum because there are times when one is better than the other. So maybe then the pain is less. But if you would have to choose just only one factor, I don't know, whatever, momentum, value, size, quality, which one you would use and why?
I would never just use one, but if I had to use one, I just going back to what can I control? Behavior, taxes, and fees. Taxes and fees are irrelevant to this question, but behavior is. So if you gave me one, and I know the one thing I control is my behavior, I'd say, well, what's one of these strategies behaviorally I could control myself best? For me, that would be value because value fundamentally I have the most conviction as like a core belief in why value works and how it works. And I know that I can stick to that strategy no matter what at the margin versus other strategies. So if you only gave me one thing, I would just focus on my own behavior. And I know my behavior would be best in a value context. So I would choose the value, like a deep value strategy, just because I think my behavioral issues would be more likely to be controlled versus if you made me do something else, would be my answer on that.
All right. And especially now, as you said, these anomalies are mean reverting. So if value had such a bad recent history, then maybe there are good times for value in the near future.
Yeah.
I have a couple of questions from my listeners, and the very first one is about the dual momentum with the idea by Gary Antonassi.
Yeah.
And what do you think about trend, absolute momentum and relative strength combined together? And as they both represent equity premium, would you agree that there is, and you agree because you said already that there is a home country bias, that Americans, they have too much American stocks, and the opposite in Europe.
Yeah. Like
in Belgium, mostly people invest on the Belgian stock market. So do you think that those two, the absolute momentum and relative strength combined, they have merit in your opinion?
Yeah. I'm a huge fan of rules, right? So anytime you can codify reasonable ideas, and it helps the investor manage their behavior because now they're just going to focus on rules and not what they think. I'm a huge fan. And that frankly applies to any system. Like anyone that has a system, I'm going to be like, Roger that. You get a check mark for good behavior at least, right? And then sometimes obviously we get into the arguments of like, well, what system is better than the other systems? And I like simple systems. And I think dual momentum is a great way to simply capture two ideas that make a lot of sense, right? Trend following and relative strength. So for that reason alone, I love it. But also going back to our original discussion, well, this is so easy a caveman could do it. And if you look at that system in particular, over the long haul, it works pretty great. The problem is in the short run, it doesn't work all the time. And because we know personally, because I know a lot of people that do dual momentum, we run systems internally that are similar. And all you hear about these days is like, why are we doing this? Why don't we just own the S&P 500? It's like, it's a lot better performing and it's like a lot better asset. It makes a lot more sense, i.e., like, man, I hate doing this stupid rules-based thing because it's underperformed for the last 10 years. Why don't I just change my rule and just buy S&P stocks because they've been doing well recently, right? So again, that would just be the challenge, just to be clear up front of why a dual momentum system might not work for you. But if you can actually stick to the program, I think it's a great idea. And I think it'd be awesome if people could do something like that.
And do you think that some merit from that approach, dual momentum, comes from the fact that indeed there's a home bias, that people go too much on the local market?
Yeah.
And by the way, do you think that having such ETF would be a great idea? Or maybe you as Alpha Architect, do you have plan to launch such ETF?
Yeah, so we actually have been contemplating. I'm actually, before this call, I was building a little model here to figure out how to put this into the structures. So we already have one system out there that does that. It's value momentum trend. And the issue, it's not an issue, but that one also incorporates like factors. And sometimes factors are a bridge too far for people behaviorally, but they do like the trend following, kind of like the dual momentum concepts, where that system is just trend, but it does passive investing, so people don't have to worry about factors. And we are in the middle of basically trying to launch like a super affordable, low cost way where people can basically implement that sort of system in real time. It's just, we've been so buried in so many other things, we haven't got around to doing that. But we are seriously looking at launching that here in the near future now.
Okay. Unfortunately, not in Europe.
Unfortunately, yeah. And I wish we were like BlackRock, where we had like money, coming out of our eyeballs, so we could go set up Alpha Architect in Europe. But we're obviously like a smaller firm, and we're all self-funded. We don't have like venture capital money. So, anytime we put money on the line, it's literally like our personal capital. And we're just in general, kind of risk averse. And we just, unfortunately, we're just not in a position to do that. But I mean, I don't know, maybe you have a listener that's like, we would love to do that. And we would love to fund that risk. Like, we'd be more than happy to help partner with somebody who would want to set up kind of these things in your guys' marketplace. But we're just not in a capital position to do so at the moment. Unfortunately, right, for you guys, but U.S. investors is great. They can do that. And maybe there's structures you could find where you could figure out how to access our things, but that's a more complicated.
I'm lucky because I have in fact access to American ETFs, but majority of people in Europe, they don't have.
Yeah.
But I have another question. Alpha Architect ETFs, I mean here about the QVAL, the value and the Q momentum.
Yeah.
Those ETFs, they are using equal weighting. And the question came from one of the listeners. Have you tried risk parity approach? And what do you think about that?
Yeah. So we've tried everything. And we run, because internally we do a lot of things besides your ETFs. We run managed futures, hedge, like we do all this stuff. So if it has a data point, we've traded it, we've studied it, we've looked at it, including risk parity and, all these things. But in this particular context here, this would be a stock selection, stock portfolio context where we run concentrated factor portfolios of 50 stocks in value or momentum or whatever. And so one of the things that's nice about brain dead equal weighting is it has very low model risk, right? Because if you just equate the stocks, you know you're getting a baseline diversification benefit, right? Because you can't screw that up too bad because you're kind of spreading your money across the basket very cleanly, right? So you know you're going to get baseline diversification there across these 50 securities. And so your other alternative, which we've done this till we're blue in the face, is there's a million other ways that you could weight the securities within that basket. And that's great because the one potential benefit of that is you might get some optimization or some, potential model benefit of being a little bit more fancy. The downside of that is you also incorporate a lot of model risk, right? Where if we don't have a ton of confidence on a first principles basis of why risk parity weighting, the 50 deep value stocks is any better than just equal weighting, we might over optimize, right? So we may accidentally lean on the model because, we think it's so great, but because of the estimation risk in the case of risk parity, where you got to estimate like the correlations and the volatilities, we may say like, you know what? The probability that the data may fool the risk parity algorithm here because it thinks that one of these deep value securities is fundamentally less correlated or less risky than these other ones. We may way overweight a deep value stock versus another because the model says to, but we know from a common sense intuition standpoint that in the end, all these deep value stocks probably have roughly the same volatility. So instead of like increasing complication and therefore model risk, we'd rather just not do that and simplify and ensure baseline diversification. So that's why in this particular context, because we think model risk and estimation risk is so high, it's just not worth going down the complexity rabbit hole because we think the simple version is just much more sane, frankly. And this is something that we always have to weigh is like complexity and the benefits versus the cost. And our kind of null hypothesis is always simple is better unless proven otherwise. And we've never been able to prove to ourselves, nor have we had outsiders prove to us that, more complex ways of going about it in this particular context make any sense. In other contexts, I'm a buyer of, volatility weighting or risk parity weighting and all kinds of other things, but not in this context of stock portfolio weighting.
Yeah, as they say, if you torture your data long enough, it will confess to you anything. So.
Exactly. You got it. Now, just to give the listener some context there, what would be a context where maybe I would do that? Well, obviously, if I had a portfolio of T-bills and stock and one T-bill, I'm probably not going to equal weight that if my plan is to try to extract or take equal risk, because obviously the T-bill has no risk. The stock has like a ton of risk. And so if I just do 50% stock, 50% T-bill, like clearly this portfolio is going to be dominated by the risk in the stock. So those are situations where, depending on your objective, maybe doing some risk parity weighting or volatility weighting would make sense because fundamentally a T-bill like clearly has a different risk profile than a stock. But, so that would be a different context where that might be appropriate. But here it's all stocks that are all deep value. No one can do enough data torturing to convince me of the common sense that these things probably all roughly have similar volatility and correlations. And I don't care how much back testing you show me, you're not going to convince me that, one stock is negatively correlated to the other deep value stock because that's just crazy, even if it is in the back test. So maybe that just gives the listener more context.
Yeah. Thank you for that. Another question. You have two ETFs, QVAL and QMOM. And the question is how you define value and momentum in those ETFs.
Sure. So we have, this is a question that can go like way too long. And I have books, we've written where we have a book called Quantitative Value and a book called Quantitative Momentum, where you could read a whole book about the philosophy of what these things do. But very simply, the quantitative value systems are trying to buy the cheapest, highest quality stocks. So very simply, what is it doing? and this is just the simple version. The value algorithms are going to try to get to the top decile on cheapness, and we use EBIT over enterprise value, which is basically operating income over enterprise value, because that is a value metric that is most fundamentally tied to how business owners think about buying a business. And it's also, in our opinion, most tied to what represents earnings power, right? It's a very simple, highly applicable valuation metric that applies to Google just as well as it applies to, some industrial factory business out in Ohio or something, right? And then once we have that top decile cheap, we then within those cheap stocks, so this is all the stocks that everyone hates, we then just do good old fashioned fundamental analysis to try to identify who is the higher quality cheap stock versus the lower quality cheap stock, which would be things like, are you making money? Are you returning are your fundamental metrics getting better year over year? Are you buying back stock? Blah, blah, blah. So it's basically Ben Graham algorithm, with a few bells and whistles. Buy cheap, and then amongst the cheap, try to get the highest quality ones, right? That's the value algorithm. And then in the momentum algorithm, the core principle there, again, there's a whole book about it, but buy winners, right? So the key thing there is we want to get to the decile of the best, like momentum stocks, which to keep it simple is just rank all securities on their past 1 year performance. We want to be looking at that top decile of winners. And then the only wrinkle there is within that top decile of winners, we want to focus on how they got to their winner status, where it's kind of long-winded. I won't bore your time here, but we want to get those winners where they kind of gradually got to that super high performance versus they, in one day they gained 100% return. And because, for behavioral reasons and a lot of reasons, stocks that are winners, but they got that winning status over like a less noisy kind of gradual momentum, those are the winners that tend to keep on winning in the future. Whereas if you have a winner that's a winner because it went up 100% yesterday, those kind of momentum stock winners, they tend to mean revert in the short run and even over the long run. So we want to try to avoid those. So we want to buy the winners, but amongst the winners, we want to try to get the winners that won slowly. It would be the easiest way to explain it. And that's basically what the momentum algorithms are trying to do.
Okay. And do you think that it's better to buy one single multi-factor ETF or to invest in two separate ETFs? Let's say if we have value and momentum, which approach you think is better or recommended?
So, like everything, there's trade-offs, unfortunately, and it's a complicated answer, but I'll try to keep it simple. So to the extent that you're doing concentrated factors, which is what we do, the difference between, mixing value momentum together in one system versus like doing pure momentum and pure value, it's hard to say which is better from like a performance or expectation perspective. And we argue maybe at the margins better, but let's just assume that they're basically the same, right? Which is probably empirically true anyways. Now it's really a question of like going back to what's the hardest part in investing: behavior, fees, and taxes. This is going to be a behavioral thing where if you look at a multi-factor ETF, the problem is ex ante, we can kind of understand what's going on, but ex post, after the fact, it's really hard behaviorally to understand what the heck was going on because you just have this pie, right? And it has all these ingredients in it. And after the fact, you don't really know what the hell was going on. You confuse yourself, and it's very hard to disentangle like, well, where was the value? Where was the momentum? What went wrong? Whereas the nice thing about having siloed approaches that are very clear and transparent ex ante, like before the case, and they're very clear and transparent what happened after the case, it's behaviorally easier to digest what's going on, right? Because you own value, you own momentum, and right now is a perfect example. If you own both of them as an integrated approach, you might be making a few percent. and the market's going to be doing whatever it's going to do. But but let's say it wasn't that case. Let's say you owned both of them and it was doing worse than the market. Now you're going to be like, oh my God, like what's going on? Is value broken? Is momentum broken? Whatever. Whereas if let's say you achieve that same end state, but you have value was down 30% and, momentum was up, let's say, 20%. So let's say the portfolio is down 10, right? And let's say the market was flat. So you're going to look back and be like, okay, no need to panic. Why am I dragging on the market? Well, momentum clearly self-identified, easy to see, did pretty well. So it beat the market. That's great. And it just had a good run. Value got absolutely destroyed. And it got destroyed so bad that the aggregate portfolio underperformed by a little bit. Well, that's fine. That's value for you, right? But at least I can, after the fact, very easily and transparently understand what was going on and why, which we believe at the margin helps people, again, sit in the seat and minimize behavioral errors, where when you get too complicated and you mix things in a big old mash pile, we found that because it muddies communications and transparency, it hurts the behavioral component of investing, basically. So again, it's long story short, it's complicated on which is better and why.
Yeah, but it was very clear what you said. So thank you for that. Wes, we are reaching to the end of this interview, but before we quit, is there anything you'd like to add, or maybe some question I haven't answered, but do you think it would be good, or you wanted to say?
Yeah, I mean, I would say that the biggest thing in financial markets is just controlling your behavior. And to the extent you can get the discipline to stick with the system, even though behaviorally it's going to be very difficult to do that when times are getting shaky, it's probably your best long-term approach. And then so follow systems. And then the other thing that a lot of people forget about is however you're going to invest, make sure that, it depends on where you are, what your locations are, but you want to try to obviously minimize your fees and your taxes as much as possible. Because over the long haul, those fees and taxes will compound in the opposite way of where you want to go as a fee payer and a taxpayer. So build systems, make sure you ensure you have your discipline to control your behavior, and just keep your fees and taxes to a bare minimum. And if you do that and stick to the program, I think it'll serve people very well over the long haul.
So trust the process. That could be the conclusion.
Yeah, and basically trust the process and don't pay too much for the process, and you'll be pretty good, I think.
Right. I really appreciate your time, and I'm sure that listeners received a lot of valuable knowledge from you. I have merely scratched your wisdom, but I want to say thank you, Wes, for that. It was a really great pleasure to talk to you and an honor to have you on my show. Thank you very much.
Yeah, thanks for having me, and feel free to reach out anytime.
Right. Thank you. Bye-bye.
Yeah.